we want to fix up the lack of housing in Australia, we have to stop jamming everyone into Sydney, Melbourne, Brisbane, Adelaide. I'm a big supporter of immigration, but you got to do it on a sustainable basis. We have a chart which shows how long it takes to build a unit, and it's almost double what it was in 2015. That extra period to build a home reflects, well, it's taking longer to get approvals done.
A lot of red tape.
Yeah, there's a lot of red tape regulations. There's more taxes imposed. There's been building material shortages. There's been labour shortages. A lot of companies, home building companies which were set up, have gone bust. We've had a record number of building companies go bust. Of the cost of building a new home in Sydney, which is about 1.2 million, 570,000 or so is due to taxes and charges. The reality is we won't be able to build 240,000 new homes unless we have more apartments in the mix, and we have to remove the red and green tape, or we need fast trains. So you can live 2 hours outside of the city. For people who manage to work, they've only got to come to the office 1 day a week, they should be able to live in Orange or Bendigo. Or the common solution of politicians, we just jam more people in, but longer term it will reduce the quality of life in Australia.
Welcome to the Property Addicts Australia podcast. We are Sana and Mona Ali, the property twins. We are mortgage brokers and buyers agents helping clients all over Australia build successful property portfolios. In today's episode, we are joined by Shane Oliver, who is the Chief Economist at AMP. Shane has been one of the most respected voices when it comes to economy and market trends. So welcome, Shane, to Property Addicts Australia.
Thanks, Sana. Thanks for having me.
Thanks, Shane. So Shane, would love to hear a bit about your story, and obviously you've been an economist for a very long time.
Yeah, a long time, decades. So I've been at AMP the whole time. So I went to school on Sydney's Northern Beaches, did economics in high school, loved economics, and decided I wanted to do economics. Not that I knew what economists did. Then I studied economics at university. And as well as law, but then concluded I didn't really like law, and so stuck with economics, got a job with AMP. This is back in the 80s, which was a very big organisation back then. It's a bit smaller these days. And of course, that was at the fantastic time because we were moving into an environment of deregulation, particularly in relation to financial markets, the growth of superannuation, investing overseas. So if you go back to the 80s, there were actually restrictions on organisations investing outside Australia. So the whole world opened up, and of course AMP had big operations in property, eventually infrastructure, and a whole bunch of other things, along with equities and fixed interest. So I've had a fantastic ride doing one of the best jobs, I think, at least for an economist, in Australia. You get to look at the economy, you get to talk to people like you guys, you get to analyse different aspects of the economy, whether it's the property market, whether it's commercial property as well, whether it's share markets, consumer spending. It's very diverse, and I also get to dabble a bit in investments. So that's my story basically, and here I am all those years later. People say, "Why didn't I leave, go somewhere else?" Well, I had a perfect job, so why would I go?
Absolutely. Well, if you've been at AMP for decades, then it's a long period of time being in one
It's certainly
place.
been a long period of time, and we've seen a lot of change through that time. Of course, at AMP went through troubles associated with the Royal Commission. That was a difficult time for me and many people at AMP, and personally a little bit depressing to see what had happened. And of course, it's hopefully now bottomed and on the way back up again. It's certainly doing a lot better than it has been over the recent years, with now more of a focus, I guess, on particularly superannuation, banking, including mortgages, and what we call platforms, the North platform in particular. So it's still out there. It's still a fantastic name in the Australian financial marketplace, and I'm still proud to be with AMP.
So, Shane, moving to interest rates, right? We hear from you often in the media and your newsletters about interest rates. Is this roller coaster over? What's happening?
It's funny, interest rates. I once saw John Howard on a plane, the former Prime Minister in Australia, and he recognised me and he said, "Oh, Shane, whenever I hear you, I think of interest rates." But perhaps because it's the most talked about topic in Australia.
Yeah.
along with the property market, but interest rates in terms of economic variables. And I think it's because Australia has this reliance on variable rates. If you go to the US, about 80% of home owners have very long-term fixed rates, and they can be for 30 years. So if you're thinking about American, they could have borrowed back in 2021 and still be paying 3% on their mortgage rate. No change. Even though the Fed raised rates and now it's cutting rates again, it would have no impact on them unless they sold their property and bought another one, then they'd have to get a new mortgage. Whereas in Australia, you've got typically about 85% variable. At one point, that fell when interest rates dropped back in 2021, and that was because you could get fixed rates at 2% or less. But now I think it's gone back to about 85, maybe 90% back to variable. So that obviously creates a lot more interest in interest rates in Australia compared to the US and compared to most other countries. You won't find so much coverage.
So will we ever go back to those levels, like 1.99% or 1.98%?
Oh, I don't think so.
Ever?
Look, it's possible, but I think it's unlikely. The way to get there, the 1.9% or whatever it was, I think it was even lower than that. You could have possibly got deals.
1.89 even.
Yeah. That happened because the cash rate had fallen to 0.1%, and the Reserve Bank was doing what they call quantitative easing. They are actually buying government bonds, long-term interest rates, and that was pushing down the long-term rates. And at one stage there, the long-term rates fell to about 0.6%. And fixed mortgage rates are set as obviously the bank has to borrow money for 5 years, whether it's Commonwealth Bank or whoever it is, they borrow money for 5 years in the marketplace out there. That's determined as a margin against the 5-year government bond yield, the rate at which the government borrows. And obviously it was all very low at that point in time. To get back to that, you'd probably have to have a similar event again, like a pandemic or at least a deep recession globally that knocks inflation back to zero. The Reserve Bank then having to cut interest rates to zero and do more quantitative easing. But I think that's unlikely.
So where we are at in the interest rate cutting cycle, right? We're in the cutting cycle. We've had 2 rate cuts already as of yesterday, this current calendar year. What's anticipated for the rest of the year?
Well, I think they go lower. Obviously, there's some economists out there who are saying, we might get rate hikes again, but that's very much the minority. I think we're in a situation where, well, to put it in context, we saw 13 hikes. So the previous rate cutting cycle started way back in 2011, November 2011, went all the way up to the pandemic when we got to 0.1% for the cash rate, stayed around those levels. And then in May 2022, and thereafter, we saw 13 hikes. Some of them were supersized 0.5% moves, and that obviously caused a lot of pain because mortgage rates went from 2 or 3%, depending on your deal, fixed or variable, to what do we get? 6.5%.
6.5%.
Yeah, 6.5%, something like that. And people are still rolling off longer dated fixed rates as we speak. So they're still jumping into that world of more pain. So that's like a 2 or 3-fold increase in your mortgage rate, which is a huge impost on people. And that led to a slowing in the economy. That's what the Reserve Bank wanted. Inflation is now coming down again. So they raised rates because inflation took off. Now with less demand in the economy, inflation's coming back down again. We've got inflation in the target range of 2 to 3%. And I think we're going to see more cuts because interest rates are still higher than what you regard as being neutral.
So do you think this rate cutting cycle will impact the economy for the better, or things will start picking up in the economy?
Well, it depends what you mean by better. I've got to be careful here because there's some people listening to this who think that low interest rates are terrible. It will just cause house prices to go through the roof.
True.
And therefore bad news for prospective first home buyers.
More so like...
But for the economy, lower rates are good.
Stimulating the economy or more spending by people,
so in that
having
sense,
more disposable income.
So you've got a bunch of people out there who have mortgage. Like the typical consumer who changes their spending is not people like me who've got the mortgage under control, or my mother who's in her 90s or something. We don't change our spending that much because we're not that sensitive to interest rates. And nor do very, very young people who don't have a mortgage. But that group of 25 to 45-year-olds, increasingly older now because people take mortgages later, they change their spending a lot. So when interest rates come down, if you've got a $660,000 mortgage, which I'm told is the average new mortgage these days, Sounds like a lot of money compared to what I had to borrow. But anyway, they would be saving about $105 a week.
Mm-hmm.
I'll call it $100 a week, just on the latest rate cut. $200, just over $200 a week. Sorry, a month rather, on the two cuts together, and that amounts to about $2,500 a year. So $200 a month.
Mm-hmm.
I was mistaken when I said weekly, and about $2,500 in annual interest bill savings. So that's quite a saving. And the people who have that saving will then feel more flexible, be able to go out and spend. Likewise for businesses, if you've got an overdraft, relying on bank finance to help your business get going, you'll free up a bit of cash flow, and that can help employ more people or invest in the economy. So in that sense, it's good news. Just worth bearing in mind, though, we did have 13 hikes, and someone with a $660,000 mortgage would have seen their annual interest bill go up by about $16,000 or $17,000. So
per annum, that is.
Per annum.
Yeah.
We've only reversed that by about $2,500.
Yeah.
So
it's not a big impact.
It's not a big impact, but at least it's going in the right direction. We've also got, I sound like the Labor government now, we've also got wages growth being a bit above prices growth. So we're getting real wages growth. That eases the cost of living problems a little bit. And we had those tax cuts in July of last year. And so on our calculations, someone with a mortgage on average earnings would probably be about, this is about a week, they'd be about $108 a week better off than they were compared to a year ago.
But do you see 13 drops now?
No, we won't go back to those lows. I reckon the cash rate will probably go back to about 3.1%. So it's currently 3.85%. The high point was 4.35%. We will see more cuts. A bit of a debate as to whether the next one will come in July or whether they'll wait to August. When you heard from the Reserve Bank governor this week, she was a lot more what we call dovish. Hawkish means inclined to raise rates. Dovish means inclined to cut rates. She was a lot more dovish, which implies that she's probably leaning towards more rate cuts. So you could get a cut as early as July. That's the next meeting. Our base case is August, but I'm not going to rule out a July cut. And then I think you'll probably get another two after that.
November and February, apparently.
Well, yeah, by February we'll be down at 3.1%.
Yeah, because RBA used to meet every single month historically, apart from January, I think.
Right.
And now they're doing it every 2 months or so.
Yeah, it's every 6 weeks.
6 weeks,
So,
okay.
Yeah. They always meet in the mid-month of each quarter.
Mm-hmm.
So February.
So they won't have a surprise cut like halfway through their
meeting cycle.
Yeah.
They could. But to get that to happen, you'd have to have a crisis.
Mm-hmm.
Donald Trump is a potential crisis. There's the tariffs. He had this Liberation Day thing, massive tariff hikes. Economists hate tariffs. Economists love free trade. Basically, if you put tariffs on, then you restrict free trade and competition. Like we used to live in Australia, and we had all these walls around us. Not only could we not invest overseas as an investment organisation, but you had to pay a lot of tariffs if you wanted to buy a foreign-made car.
Mm-hmm.
So we all drove Holden Kingswoods and Ford Falcons, which were beautiful cars. I don't know if you're into cars, but they are beautiful cars, and I still dream about them. Whenever I see one driving down the road, I think, God, we used to live in a good world with those cars. But anyway, they were lower quality compared to the imports that were coming in, and people increasingly wanted the imports. The government realised this was all stupid, so the tariffs were cut. Mm-hmm. And we ended up with a more flexible economy. Whereas Donald Trump is trying to go back to that world where everyone drives a Chevy or a Cadillac. But I don't think that's possible. When I was a kid, we used to watch Happy Days. Ever heard of Happy Days? It was a TV show.
No.
It was made every so often America sort of dreams of the past. So in the 70s, America started, because times were tough in America in the 1970s, they started dreaming of the 1950s. And so they would watch this TV show called Happy Days. And I kind of think Donald Trump is again thinking maybe he wants to get back to the 1950s where all production was occurring in the US. But that's ridiculous because American wages are 5 times higher than they are in China or India or somewhere. So it's not feasible to bring all production back to the US without a huge cost. Now anyway, in putting tariffs on, that is a potential shock because it means less trade globally, less demand for our exports. That could hurt our economy. Then you could get more aggressive rate cuts.
But RBA, their goal is not to depress the house prices, right? When they do these rate increases or decreases, they're not stimulating the housing market
Or not intending to.
or not intending to,
They're not
as much as
intending to.
people think that's their goal.
No, they don't care about the housing market. Well, they do care about it. It's part of the economy, but they're setting interest rates for the average of the economy. So they don't set interest rates for first-home buyers. They don't set interest rates for renters. They don't set interest rates for owner-occupiers. They're setting, or investors, they're setting rates for the average of the economy. Now, unfortunately, when you cut rates, there is a tendency for house prices to then go up. And that's okay initially. The Reserve Bank might say, okay, well, we're trying to stimulate the economy. We cut rates. People go and spend more. People borrow more. People pay more for houses. House prices pick up. And it's an outworking of that. But it's not their end point. What they're trying to do is support overall economic conditions, stop unemployment from rising. The problem for the Reserve Bank, and they often get blamed for high house prices, is that it's not something they can really control ultimately. If we want to fix up the lack of housing in Australia, we have to fix up the lack of housing. We have to build more houses. We have to stop jamming everyone into Sydney, Melbourne, Brisbane, Adelaide. We've got to spread people out more around the country, and that's what we never seem to be able to do. And so the Reserve Bank, unfortunately, they cut interest rates. You know, each 0.25% reduction in interest rates means you can borrow, roughly speaking, you might know the answer to this more than I do, you can borrow, roughly speaking, about $9,000 extra from the bank.
Well, that doesn't really make a huge difference.
No, but you get several rate cuts.
Yeah.
So you know, February 0.25, May 0.25, July or August another 0.25, blah, blah, blah. Eventually it all adds up, and before you know it, you can borrow an extra,
50 to 100 grand.
Yeah.
But Shane, you know,
but it has the effect.
Yeah.
You get more money because you can borrow it from the bank, and then when you're all getting more money from the bank, you also show up to buy a house, and it pushes the house price up compared to what it otherwise would have been. So that is an outworking of this. But unfortunately, it's not something the Reserve Bank can control. The solution to that is supply more houses. If we have more supply, then that will keep house prices.
But will Australia be able
control.
to supply to match the population growth?
Well, we should be able to. Otherwise, we've got to question why we're having such big population growth. If you can't supply enough homes to house the people in the country, then you've got a bit of a problem.
But is there a plan though?
Well, there is a plan. The Labor Party has a plan, which is the build 1.2 million homes over 5 years. I think, which is 240,000 homes a year. In any given year, Australia does build about 180,000 homes anyway. So they're talking about building an extra 70,000 homes a year. I'm a little bit sceptical as to whether they can do that. But if we manage to do that and we get immigration back to more sustainable levels, because lately immigration popped higher because of the return of students coming out of the pandemic. And immigration is good for Australia. You know, it's a good thing. That's why Australia is so dynamic, because you've got people of different cultures coming to Australia. And in fact, my wife is from Sri Lanka, so I'm a big supporter of immigration. But you got to do it on a sustainable basis. You don't want too many people coming at once, because then you end up with homeless problems, and there's a backlash against immigrants and so on. So you got to do it in a balanced way. But if we can get immigration levels back to I'd say around 200,000. The norm is about 240,000. And at the same time, we're building, say, 240,000 homes a year, then we should gradually be able to rebalance the property market. The question is whether you can build that many homes.
Yeah, because construction costs have also substantially increased over the last few years.
Well, that's a problem.
Yeah.
In fact, when we have a chart which shows how long it takes to build a unit, and it's almost double what it was in 2015.
Yeah.
And why is that?
Well, that's a good question. I remember in 2015, you'd drive around Sydney and there was a company which used to count the number of cranes. You'd see cranes all over the place. And you're starting to see them again. If you go up here, you'll see lots of cranes around here, particularly St Leonard's area. And that's part of the metro and the government wanting to put more people in these sort of hubs, so to speak. But so why has it gone up? Well, that extra period to build a home doubling, or unit rather, reflects, well, it's taking longer to get approvals done.
Red tape, a lot of red tape.
There's a lot of red tape regulations. There's more taxes imposed. The HIA, the Housing Industry Association of Australia, has done a study which shows that about, of the cost of building a new home in Sydney, which is about 1.2 million, 570,000 or so is due to taxes and charges. So a massive amount of tax and charge there, red tape, green tape. So the environmental regulations have tightened. There's been building material shortages. There's been labour shortages. A lot of companies, home building companies, which were set up, have gone bust. We've had a record number of building companies go bust because they do a quote and then find that they start the project, takes longer, and their costs blow out, and then they fold. So there's been a bunch of factors behind that. But basically, to build more homes, in the short term, we have to go back to building more apartments. Lately, the mix has skewed more to standalone houses. The reality is we won't be able to build 240,000 new homes unless we have more apartments in the mix, and we have to remove the red and green tape and tell councils to move faster. And then longer term, I think we need to stop all living in the same place. You need more people living outside Sydney. I mean, if you think about those people who were bombarding us on our phones just prior to the election, the patriots, what do you call them? The trumpets. The trumpets of patriots. One thing in there, I mean, a lot of it was silly stuff in there, but one thing in there they said was, well, we need fast trains so you can live 2 hours outside of the city in normal travelling conditions, but if you have a fast train, you can get in there within 20 minutes. So for people who manage to work, they've only got to come to the office 1 day a week, they should be able to live in Orange or somewhere, or Bathurst, or in what's that other place, Bendigo or Ballarat. You should be able to live in those centres and then come in for your 1 day a week and then go back home again. But that only works with faster infrastructure. So it should be encouraging more people to decentralise. That's what you've got in the US. If you look at Demographia, which publishes this annual comparison of housing affordability, Australia is right there at the top. We're about the most expensive. It's about 12.7 times annual average wages to pay for a house in Sydney. Whereas in a lot of US cities outside of LA and New York, you're looking at 4.5 times or something.
It's quite spread out, the US.
But that's the thing, America has spread out.
Yeah.
They're not as concentrated in big cities as we are.
Yeah.
They do have big cities, and those big cities are expensive, and LA has a housing problem. San Francisco has a housing problem like we do. In fact, homelessness is worse in these cities than here. But beyond that, there's lots of places in America where you can go where it's 200,000-300,000, but housing is a lot more affordable.
Yeah. And what about our markets? Let's go like city by city. Like, what's with Sydney and Brisbane's resiliency?
Well, lots of people and not enough houses. It's always supply and demand. It's always economics, basically. But Sydney is seen as a very international city. And so that, it's seen as a comparison to living in Hong Kong or somewhere like that. So it has to be seen as somewhat international. It does have ridiculously high prices, but as I mentioned to you a week or so ago, it's little. When you watch Lux Listings, that TV show on Amazon Prime, I think it was. It was just amazing how Sydney looks so beautiful in that. It was a fantastic TV show just to see it. I don't know if you know those guys in Lux Listings, but anyway, what you see in Sydney is obviously very expensive properties. The median price is, I think, a couple of 100,000 above where it is in Brisbane. So if you run through Australian cities, Sydney is the most expensive, and that also is in relation to wages. But it certainly has a shortage of property, and that's the basic factor pushing prices up. Melbourne, I mean, if you can divide Australian cities up in half, thinking about the last couple of years, you've got Sydney, Melbourne, Canberra and Hobart and Darwin, which has been a little bit on the soft side. So Sydney and Melbourne in particular had a big run up going into the period before the pandemic, and then Sydney continued, particularly after that. So that left it severely unaffordable. Those cities have had a bit of a dip back to varying degrees. Now they're starting to pick up again with the low interest rates. Sydney came off a little bit, Melbourne a lot more, and Hobart a lot more. So if I was saying I'm looking for value in Australia, I'd probably say Melbourne is probably somewhat more valuable. It's somewhat cheaper.
Despite all the levies and taxes.
Well, that's the problem with Melbourne, that the state government there has gone crazy with various levies on investors. So that complicates it a little bit. I think if you're an owner-occupier, I think there's better value to be had in Melbourne than in Sydney, Brisbane. Perth, it's about the same. Adelaide looks very expensive to me. But I kind of think that the basic resilience around Australia is supply and demand. Too much demand, lack of supply. Melbourne is not quite as bad because they tend to be able to build houses a bit quicker. I think if you're looking for better value as a home buyer, putting aside the property taxes, Melbourne's probably better value. Likewise, Hobart's reasonably good, possibly Canberra. Sydney, I think you probably only go there if you have to and you want to live there or you're already there. But I think what's going to happen here over the next year with interest rates, Melbourne will probably pick up relative to the cities at the other end, which is Brisbane, Perth and Adelaide. Now, they've been booming. They did go through a lengthy period of underperformance, particularly Perth, but in recent times, particularly the last 2 years, they've done exceptionally well. And they're now looking a bit unaffordable.
Yeah.
It beats me why anyone in Melbourne would think I'm going to relocate to Brisbane, because they'd end up paying more for a property there. Likewise, it's a bit hard to understand why Adelaide is so popular and so strong, although it's a beautiful place to live, but it does seem a little bit vulnerable to me. So what I think will happen is you'll see Melbourne in particular start to accelerate. Brisbane, Perth and Adelaide will slow off a little bit.
Oh, and Brisbane has the Olympics coming. Do you think despite that it might slow down a little bit?
The Olympics might help, but that's still, when is that?
2032.
So it's still a few years
7
away.
years.
Yeah. I mean, there'll be a lot of excitement around Brisbane in the years prior to that, but I think that excitement's probably still 4 or 5 years away.
Yeah.
But Melbourne rental yields are known to be low. You still believe it will still accelerate despite the low returns?
Yeah. For an investor, it's more difficult. I think if you're owner-occupier, you'd probably say Melbourne's a better place right now. If you're an investor, you've got to be a little bit careful because of the taxes and charges and the vacancy factor. Rental vacancy factor is a bit higher in Melbourne, and the rental yields, the rents aren't as good for investors.
But is that because they've built more houses compared?
They've done a better job of supplying houses.
Yeah. But do you see if there's a change in the state government that these levies or these taxes might just be scrapped?
Yeah, probably. I mean, it's difficult. Victoria just announced their budget, and Victoria is probably the most problematic state in Australia right now because of its excessive debt levels, and it's got the lowest credit rating of the Australian states. So credit rating is a rating put on a borrower by an organisation like Standard & Poor's or Moody's or Fitch. And Australia is AAA and Victoria is AA, which is still good, but it means they are paying more to borrow money than in other states. Now, we just saw another budget there and they've done a whole lot of extra spending, free public transport for kids and a lot of handouts, and it looks like the budget situation is even worse than it was before, the way I look at it. And that is obviously problematic. And so I think if there were a re-election of the current government, then they're not going to remove those taxes and charges. If it's a new government, then there is a risk that they may they may conclude that the best thing we can do is cut all the handouts, the free public transport, and at the same time reduce some of those property charges. Because the problem with the charges that have been put on in Victoria is that it's working against economic growth in the state, because businesses are saying, well, I won't go there, I'll go somewhere else. Property investors are saying, I won't go there, I'll go somewhere else. And that's working against things, even though it might be popular. to protect households, but it could be working against households in the longer term because it means less economic growth in Victoria.
But the fact that Melbourne seems quite good value for money in comparison to, say, Brisbane and Perth and Adelaide. So would people just buy because of that, because it presents good value despite the taxes?
Well, it depends what you are. If you're an investor, you'd probably have to think twice because you've got to allow for the property tax imposts. If you're a owner-occupier, you might think, well, I'm sort of looking at Australia as a Martian. So where would I go? You might think, well, Victoria might be better because it's got somewhat cheaper housing compared to Sydney, and now versus Adelaide and Brisbane.
Yeah.
So if you're an owner-occupier, you might still go there. And like Sydney, I mean, it's a big city, so it has good job prospects.
Yeah. But do you see Melbourne catching up to, say, Brisbane and Adelaide? I mean, it's really fallen behind.
Well, there's always a cycle there. I mean, there's the one thing you notice about everything, interest rates or property. I mean, property just seems to keep going up, but property does have setbacks. We had setbacks in what it wasn't as clear up until the 2000s, but we did have a setback at the time of the GFC. Then we had a pick up. Then we had another setback generally around Australia around 2017 to 2019.
Yeah.
And that was at the time of the Royal Commission and the tightening in lending standards.
Yep.
Then we had a recovery. Then we had another dip at the time of the pandemic, then a recovery, then a little dip when they started to raise interest rates. So you're occasionally getting these little dips, even though they don't seem that big. But there's always a cycle there. And I've looked at the relative price growth cycles of, say, if you compare Sydney and Melbourne, which are often similar compared to Brisbane, Adelaide and Perth, and they tend to go in these 5-year cycles where you got a phase where Sydney and maybe Melbourne are doing well, Brisbane, Adelaide and Perth are not. Then you go through a phase where Brisbane, Adelaide and Perth are doing really well and Sydney and Melbourne are not doing as well. And it partly reflects the phases in interstate migration. Now, people go through phases where they say, I'm going to relocate to southeast Queensland, and then they go through phases and say, well, it's too late now. The prices there are too high. I'm not going to do that.
So the immigration won't be as much as it has been. Interstate migration.
I think it will slow down. You'd certainly be crazy to move out of Melbourne now and go to Brisbane because it's more expensive.
You'd be paying much more money for the same.
I don't think Queenslanders like people coming there either.
Well, they probably don't, but that's where a lot of their growth has come from, that they have more people coming there and that grows the economy. But it does have the effect of causing crowding and higher property prices.
So talking about the cycles, you said 2017 to 2019, there was a bit of slowdown in the Australian property market. And we had interest rate hikes from May 2022 onwards. So do you think we are past that period of time or slowdown in the market, and now with the rate cuts, we are on an upward cycle moving forward?
It's probably an upward cycle. And the debate amongst most analysts is whether it's going to be modest or strong. The argument for a strong recovery is that once rates come down, it normally invigorates the property market, and then you get a strong recovery. The counter argument is we're starting this upswing from a point of poor affordability. So if you look at price to income ratios, they're already very high. We haven't really had much of an improvement, and that would therefore constrain the size of the upswing. Like we had 13 rate hikes, but the property market bottomed out after so we had rate hike starting in May 2022. Property prices fell for about 6 or 7 months and bottomed out at the start of 2023. And despite more rate hikes, property market took off because of the surge in immigration and the shortage of supply. So this cycle's been a bit unusual, and that you've had these conflicting forces. And normally you would have seen bigger falls in prices as a result of higher interest rates, but we didn't see that. So I suspect that lack of weakness in the property market through the interest rate tightening cycle means that they may not go up as much. So therefore, I think it's probably going to be a bit more constrained.
Yeah, not during the pandemic, some markets.
Yeah, through the pandemic, it was odd.
Yeah.
initially prices came down, and then once I think Australians realised they're not going to lose their job, or if they do, they're a JobKeeper or something or other, and interest rates went to zero. So the cash rate went to 0.1, mortgage rates went to 1.9 or whatever. Then Australians thought, oh, gee whiz, this isn't too bad. I've got my job. I've got super low interest rates, buy property.
Yep.
And average prices went up 30%. This time around, interest rates aren't going to go back that low. We haven't had much of a fall in property prices. Affordability is a lot worse. So therefore, it's going to be more constrained.
So someone looking to buy today, they don't necessarily need to FOMO in. They can just take their time.
Yeah, probably.
But Shane, you touched on Melbourne accelerating, and Sydney will, while Brisbane, Adelaide, Perth might take a little bit of a backseat or a breather. So then does it mean Sydney will grow if Melbourne's accelerating?
I think they'll all grow.
But like 2013.
I think the pace of growth might not. Yeah, I think what will happen is the relativities will change. So Melbourne will start to look stronger. Sydney will sort of, I don't have a strong view on the relativity of Sydney. Sydney will be okay. Perth and Adelaide and Brisbane will slow a little bit, but still grow. So I'm going to put numbers on it. Melbourne over the next 12 to 18 months might grow 7-8%. Sydney could be, I'd say, 3 or 4. Adelaide, Brisbane and Perth a little bit more constrained than that.
Yeah. Well, they have been growing for quite some time.
Yeah, because it takes me back to 2013 when, we were building our portfolio in Sydney. You were seeing like 70, 80 people through an open home.
That hasn't happened in a long time, I would think.
No. It may, there's conflicting forces here. On the one hand, we've got less immigrants coming in. We know when you could tell if I'm right on this, but it seems there's less people showing up when a rental property is for lease. Vacancy rates have picked up a little bit. Got more kids sharing, young people sharing when they first move out of home with their parents. The auction clearance rates are okay, but they're not fantastic. Although I have noticed Melbourne's looking a lot stronger lately. Sydney's more iffy. Sydney clearance rate on domain numbers looks to me around average for this time of year. Melbourne is pushing around 70%, which is actually quite strong for Melbourne.
Yeah, but Melbourne is a market where auctions are much more common though.
I know. Else. Yeah, but if you look at the clearance rates,
it's higher than average now.
It's higher than average, whereas Sydney is around average or just below average. Suggesting that Melbourne's picking up a little bit more. If I look at the CoreLogic numbers so far this month, we're seeing price gains, but Melbourne looks a little bit stronger than Sydney does. So it seems like Sydney's sort of a little bit constrained. But as to your question, will rate cuts excite people? Well, the first one didn't really. I think it provided a bit of a boost. Then it sort of faded a little bit. And it may have faded, you don't quite know, because Trump and his tariffs, that scared some people. So suddenly all this talk about recession happening, and then people thought, oh, maybe we better wait and see. But this time around it's a little bit different because now we've got another interest rate cut. Back in February, the Reserve Bank was a little bit cautious when they cut, as if, we're cutting, but don't expect more. We might just hold. And now here we are, we've got the Reserve Bank cutting. Looks like we might do more, which is a different sentiment. That could potentially get more buyers out there.
Yeah. Well, it'll be interesting to see what happens on the ground, because as buyers agents, we understand that, in Melbourne at least, there's 25 to 30 groups through at some opens for good quality properties.
Multi-offer situations to secure at least on the cheaper, I guess maybe anywhere from 500 to 800K price bracket at the very least. It's it's heating up. And Shane, what about the age-old debate of shares versus property, right? We hear about it often. What's your take?
Well, if you look at shares versus property over the very long term, they're similar. Like I've got data going back over the last 100 years, and shares return about 12% per annum. And so I'm including capital growth in the value of the shares plus the dividends, and property is fairly similar to that, about 12% per annum. This is Australian residential property. Now, this is pre-tax. So if you want to get finicky about it, you got to add the franking credits in if shares, so that adds about 1.5%. And for property, you get into a debate about gearing, because people tend to gear their property investments a lot more than they gear their share investments. You can gear your share investments several ways. One is via margin debt, but that can be quite expensive and you get margin calls. Alternatively, you got your family home, you can borrow against the family home and gear into shares. So you could still, gear them equally if you want to, but it's not as common. If you allow for gearing in property, the fact that there's more debt associated with property, then it has higher returns.
Leverage.
Than shares. Well, it has more leverage associated with it, so it generates higher returns. But when you look at the underlying capital growth and rents you get for a total return on the average property, then they're similar to shares. So my conclusion is an investor should have both in their portfolio. So if you're, and I include the family home. So if you're someone with a family home and you add up all your wealth and it dominates, it's 70% of it, then you should consider having more shares. And then your super might give you some of that as well. But by the same token, if time goes by and your superannuation builds up and you find that it skews the other way, then maybe you should get some more property in your portfolio. So I think there's a role for both in a portfolio, and they are different asset classes. They're both growth assets, unlike cash, which is money sitting in the bank. Famous quote on that is that no one got rich on bank interest, except when I started my career, there was one phase there where I could have money in the bank. It's called Chase AMP. AMP had a banking venture with Chase Manhattan, and the rate of interest was 16% at call. At call.
Wow.
But that was a very brief situation. It was in the late 80s. But you wait today, what do you get at call now? 3% or 4% or something. It's not very good. So they're both growth assets, but shares are highly liquid. If you want to buy and sell, you can do it instantaneously. Click. You can do it by pushing a button on your internet and or on your share account, and the transaction costs are very, very low. But the downside with shares is that they're very, very volatile. They'll move around a lot, whereas property is a lot more illiquid, but it's more stable over time compared to shares. So I think that the bottom line is there's a role for both in there. And if you're going to ask me which one is better from here for the next 12 months, I'd find that a difficult one to answer. I'd probably say they're both about equal.
So we can't predict where our markets might be in the next 5 to 10 years then, where Australian property markets could
Well,
land.
you can have a go. 5 to 10 years, I'd probably say they'd be the same.
No, you mean in terms of growth?
Well, I think you'll probably get capital growth out of property. Like income growth will probably be 4.5%. So if you look at growth, historically, property has gone up with the economy. So if nominal growth in the economy is, say, 2.5% plus 2.5% inflation, that's 5%. So you could probably assume that you're going to get about 5% capital growth
per annum.
Per annum, and then to which you then your rental yield to give you a total return of 9% or something, depending on how you include costs in all of that. For shares, I don't think it'd be radically different. It's just right here, right now, I don't have a strong view on the relativities of the two.
Yep. Well, Australia is as a whole unaffordable, though, as you know. Well, that's just our view, because we hear from our clients a lot. What's going to happen with our future generations, our children? Will they be able to even afford a property? So that's why people are looking to obviously
what
build
do you
property
say?
portfolios. Well, take action in the present moment and do whatever you can to
Buy
hedge
property
yourself.
for your children.
To hedge yourself for future.
You hear this, the government's talking about changing the superannuation tax. So there's currently 15% on earnings on superannuation. For balances over $3 million, they'll double that to 30%, and it'll be on unrealised gains as well. So it's just a change in the value of your superannuation balance above $3 million gets subject to a 30% tax. And there has been some anecdotal reports of people selling out of their superannuation and then going into the property market. I mean, there's a counter argument that some people in the super have property in there, so they'd be selling the property in the super, but predominant one seems to be they're selling out of their super. If they can, if you're over 65, you can do that. And then you buy property and use the benefits of negative gearing and the capital gains tax discount. So that's a possibility. I think it's a huge problem. I think it's grossly unfair that we in Australia have arranged the situation. I don't think consciously, it sort of drifted upon us, but it's led to a situation where property is very difficult to get into for younger people unless you've got a BOMAD, Bank of Mum and Dad, the BOMAD Bank, and which is grossly unfair because not all kids have wealthy parents who can afford to lend them money.
Well, especially if you're an immigrant, right? You don't come with
you might not have that. So it seems we've set up a situation which is inequitable. So it's inequitable across generations and also across income levels and also depending on how well off your parents are. And that seems ridiculous to me because we are a country with a lot of land. Even if you look at Australia and say, oh, well, a lot of it's desert, you're not going to live there. The arable land in Australia is huge compared to many other countries, and there's a lot of space out there, and we just haven't arranged things very well. And the common solution of politicians, we just jam more people in. You put more high rise up here and there. That's well and good in the very short term, but longer term, it will reduce the quality of life in Australia. So that's why I think we do need to focus on shifting people away from capital cities, encouraging the ability to work from home and live more remotely for some who can do that. I'm not saying it's going to work for everyone. Younger people obviously want to come into the office and do all that sort of stuff, and you do need, for cultural reasons, you've got to come into the office some of the time. But where possible, we need to decentralise away from our big cities. And unfortunately, our politicians aren't really focused on that. They're just sort of focused on short-term fixes. And the other problem politically is that the bulk of voters actually are homeowners. 2/3, 1/3 either own their home outright, older people normally, or 1/3 are paying off a mortgage. So the votes are actually in the homeowners, and they don't want prices to go down.
So, well, that's a wrap. Shane, so much valuable information today for our listeners, and hopefully, we can build more houses in this country. And thank you for joining us today at Property Addicts Australia.
My pleasure. Thanks for having me.
Thanks, Shane.
Thanks for listening. Join us next time for another episode of Property Addicts Australia.